Major companies around the world are cutting jobs, striking giant mergers, and adjusting strategies. And these moves are quietly reshaping the job market, prices, and how people like you plan their financial lives. Let's break down what's really happening. Across 2025, both expected and surprising shifts hit global business headlines. Global layoffs continue in tech, retail, and services as companies restructure for efficiency. In the US and UK, unemployment data shows rising joblessness, nudging central banks toward potential interest rate cuts. Big mergers and acquisitions are surging as corporations chase scale and strategic advantage. These stories might feel distant, but they're not just background noise. They influence paychecks, savings, career paths, and even costs for everyday goods. Let's start with layoffs, one of the most talked about developments. In 2025, layoffs are not confined to small companies or struggling startups. Major corporations like Amazon, Verizon, Chevron, Starbucks, and others have announced cuts, citing cost control, technological change, and shifting consumer behavior. A key driver is automation and artificial intelligence. Many firms are investing heavily in AI to streamline operations, but that often means fewer human roles for tasks that machines can perform. McKinsey, a global consulting firm, is also planning job reductions as it adapts to slower demand and technological change. What's happening is not just random firings. It reflects a long-term shift in how businesses organize work. So, why does this matter for you? Layoffs may seem like a corporate issue, but they rarely stay there. Here's how it connects to your everyday life. 1. Job competition increases. As companies streamline and rely more on technology, competition for the remaining roles, especially good ones, intensifies. 2. Wages and hiring slow down. When unemployment rises, employers feel less urgency to offer big raises or expand payrolls. That affects wage growth and job mobility. 3. Mental load and security shift. With job stability feeling less certain, more people are thinking in terms of career resilience, meaning building skills, networks, and financial buffers. While layoffs capture headlines, the corporate world is also buzzing with mega mergers and acquisitions. In 2025, the total value of global M&A deals has climbed dramatically, with landmark bids like Paramount's Skydance for Warner Bros. Discovery and Union Pacific's massive purchase of Norfolk Southern leading the way. Why are companies doing this? 1. To gain market share. 2. To cut costs through combined operations. 3. To compete globally with fewer but stronger rivals. This trend matters for regular people like you, too. Here's how mergers and acquisitions can filter down to your pocket. 1. Prices and services. When big companies combine, they sometimes reduce competition, which can lead to higher prices for goods or services. 2. Fewer choices. If the number of players in a market shrinks, consumers may have less bargaining power, like fewer airlines on a route or fewer tech platforms competing for your attention. 3. Job realities. Newly merged companies often eliminate duplicate roles, meaning layoffs aren't just about cost cutting, they're about streamlined structures. That intensifies pressure on the labor market. In both the United States and the United Kingdom, the jobless rate rose in late 2025. In the US, unemployment hit a multi-year high even after some job gains, putting pressure on central banks like the Federal Reserve to consider interest rate cuts to support the economy. That's significant because interest rates affect many aspects of everyday finances. For instance, mortgage and loan costs can fall if rates are cut. Savings interest may also stay lower. Business investment decisions change when borrowing costs shift. So, even if layoffs hit media headlines, the wider effects like rate changes can influence your budget and cost of living. So what should you take away from all this? 1. Build a financial safety net. Ensure you have emergency savings, ideally 3.6 months of expenses, so you're not caught off guard if the job market tightens. 2. Adapt and upskill continuously. As companies restructure, the demand for adaptable, tech-savvy, and cross-functional skills rises. Invest in learning. 3. Diversify income streams. Relying on a single job can be risky in an unstable market. Side gigs, freelancing, or monetizable hobbies can reduce pressure. 4. Be aware of price trends. If mergers tighten markets, prices on certain goods and services could rise. Watch your biggest monthly expenses like groceries, telecom, transport, and adjust spending. So, let's recap. In 2025, we're seeing two sides of the corporate coin: job reductions and massive strategic deals. These developments might seem like business news, but they're actually shaping your financial reality. From job prospects to interest rates to how much you pay for everyday products. Understanding these shifts doesn't protect you from uncertainty, but it gives you the knowledge to make better choices about your money, career, and long-term planning. Note, this content is for educational purposes and not financial advice. Always consider your own situation and consult professionals when needed. Like, share, and subscribe for more smart money insights as we break down big business news in simple terms and help you make sense of events without the noise. Thanks for watching.